In this video, we talk about how to manage a large set of risk premium factors. Assume you have found a set of risk premium factors, capital F. Empirically, these factor premiums share a substantial cross-correlation among each other, which creates numerical instabilities and ambiguous interpretations. I therefore advise you orthogonalize the risk factors. Without losing information, we rotate F into G, such that each risk factor premium has a mean of 0, a variance of 1, and a 0 correlation with all other rotated risk premium factors. The mathematical shortcut is as follows, where Scholl sigma F is the lower triangular Cholesky decomposition of the covariance matrix sigma F, and G is called the Gram-Schmidt Orthogonalization of F. Now look at that equation and appreciate the following intuitive features. The first risk premium factor in G is simply the z-score of the first F risk premium factor. This says that it is demeaned and has a unit variance. The second risk premium factor in G contains only the information of the second risk premium factor that is new relative to the first risk premium factor of F and G. The third risk premium factor in G contains information of the third risk premium factor of F that is orthogonal to the first and second risk premium factors of F and G. Now, I hope it's helpful to visualize exactly that intuition using now another concept, the concept of linear projection. So let F1 up to Fk be the time series of the k risk premium factors. Subtracting the sample mean of each risk premium factor gives us F1 tilde up to Fk tilde. So the tildes in F are demeaned risk premium factors. Now we call G1 up to Gk to be the Gram-Schmidt Orthogonalizations of F1 up to Fk, if the following holds. Let's focus on G1 first. So G1 will be defined as G1 tilde divided by that strange looking notation where we have two bars on the left and on the right of G1 tilde. That's called the norm. And I already mentioned, since G1 tilde is of mean 0, that norm is simply the volatility. So whenever you see these two bars with a term inside, just swap that being the volatility of the term inside. Okay, so the G1 here is G1 tilde over its volatility. And G1 tilde is simply F1 tilde. So that's the demeaned first risk factor. So you see that the first orthogonalized risk premium factor is nothing else than the original risk premium factor, demeaned and divided by its volatility. Hence, I call that the z-score. Now, more interestingly, let's go to the second orthogonalized risk factor, G2. It's defined as G2 tilde over its volatility. And now look at what G2 tilde is. It's F2 tilde, so the second risk premium factor, demeaned, minus the projection of F2 tilde onto G1 tilde. Meaning if you project the second risk premium factor on the first, everything demeaned, you end up with an epsilon, with the residual information, with information in the second risk premium factor F2 that is new relative to the first risk premium factor. And that exactly is what G2 tilde will be. And then we divide that by its volatility to standardize that. So you really see how the orthogonalization makes every new risk premium factor keep only the information that's new relative to all the previous risk premium factors. Yeah? Last, look at G3. It's defined as G3 tilde over its volatility, and G3 tilde is you take the third original risk premium factor, it's the mean, that's why there's a tilde on the f. And now you subtract from that the projection of f3 tilde on g1 tilde and the projection of f3 tilde on g2 tilde. So it's really g3 tilde is the epsilon you get when you regress f3 tilde on g1 tilde and on g2 tilde. Okay, and then you continue with up to the kth risk premium factor like that. Now let's look at an example to make it more tangible. Assume you work with a linear two-factor beta model. One risk premium factor is the market excess return, so F1 equals Rm minus Rf, while the other one is the value minus growth factor, so Ft will be Rhml. Empirically, both risk premium factors are correlated with each other. This makes it hard to understand which risk factor information is driving the expected return of an asset. Applying a Gram-Schmidt Orthogonalization means you first demean both risk premium factors to get F1 tilde and F2 tilde. Then you compute G1, which is F1 tilde divided by the standard deviation of F1 tilde, and you compute G2, which is F2 tilde minus the projection of F2 tilde on G1 tilde divided by the standard deviation of that spread. Now the latter says that G2 contains only the information of the value minus growth return that is orthogonal to the information in the market risk premium. Now one question might pop up. What does the linear factor model look like if we use the Gram-Schmidt factors? Well, I want you to verify that it looks as follows. Where Scholl sigma f is the lower triangular Cholesky decomposition of sigma f, Scholl transpose is the respective upper triangular Cholesky decomposition of sigma f. G is the T times K matrix of Gram-Schmidt orthogonalized risk premium factors, and lambda f is the expected market price of factor risk premia f. And note, if f are tradable excess returns, then lambda f is simply the expectation of f. And that last equation highlights nicely that in linear factor pricing models, an asset's expected risk premium is paid for covariance risk only.
Got feedback? We would love to hear it. Please drop us a line. And if you liked the video, give it a thumbs up. And don't forget to subscribe to the channel.